the Global Energy Leaders Podcast, episode 100.
Welcome to the Global Energy Leaders Podcast, powered by R Squared Global.
Welcome to the 100th episode of the Global Energy Leaders Podcast. As always, I'm your host, Ryan Ray. So good to have you, and today I'm not going to talk and ramble. I'm getting to it. The man, the myth, the legend, the godfather of energy podcasts, Mark LaCour is here. So without further ado, here is Mark LaCour. Well, Mark LaCour, it's an honor to have you back on for episode 100. If you remember, guys, maybe about a year ago this time, we were talking about this podcast, and here we are, episode 100, your third appearance on the show. We really appreciate it. How are you doing today?
Doing awesome, Ryan. I appreciate you having me back on the show. This is the third time. I feel honored.
Well, you are as I say, the godfather of energy politics. If that catches on for you, I want you to know I have the copyright to that, but I'll be happy to to work out something with you. Well, let's get into it. There's three things I want to talk to you about today, Mark. And first, I want to start off with the EIA data and the debate that's going on right now. It's kind of catching a little bit of traction. Harold Hamm and some others are saying, hey, you know what? These EIA data is wrong. Now, we know that the EIA data is wrong on some level because they go back and correct their numbers, but they seem to be indicating that the margin might be even larger than what the EIA is reporting, which could lead to, at some point where we sit back and we go, oh, my goodness gracious, we don't have nearly the supply that we thought we did, which would dramatically impact prices. What's your take on this debate?
Yeah, so this is a hard one because we're all on the outside looking in. Now, I'll tell you something. Harold Hamm, who's the CEO of Continental Resources, he's an oil guy. He knows what he's doing, right? And when you're running a company as large as Continental, you have to be looking out ahead, and you have to understand what the market's doing, right? This is the type of work that the old modal point, we used to do this all the time for our clients. You know, what's the future going to bring? What is the data telling us is out there, and how's that going to impact our business this year, next year, and the year after? What's interesting is they have a very large discrepancy. You would think that if there was a discrepancy, it would be smaller, right? Because everybody has access to just about the same data. And there's some variables in here, and I can't remember if you and I talked about this before, but the data that you get from production from the U.S. and Europe is pretty darn good. You can take that to the bank. It's the rest of the world that intentionally skews their data. So the production from the Middle East, Russia, China, they don't put the same amount of rigor in making sure that what they report is legit. And they do it a lot of times for political reasons. They skew that data to help their own countries politically. We actually do this thing, and we call it the truth mean, where we look at the Middle East production data. We've been doing this for 6 years now. And we look at what they say, because a year after they give their forecast, you can pretty much figure out what the reality was. And so we do the math and we come up with the difference between what they say and what the actuality was. And of course, that data is always a year old. And then we turn that into a mean. So not an average, but a mean. And then what we do is every year when we get their production number, we apply that mean, that truth mean to their data to try to get some accurate information. But it's so hard to do it. Harold knows the industry, but you would think the EIA would have a lot of incentive to be accurate. The thing that I'm curious about, Ryan, is if there is a delta between what the EIA is forecasting, why is there a delta? And I can't, it's probably a political reason if it's there, but I can't quite put a figure on why they would do that.
Yeah, and as you mentioned, there's everyone. We kind of have the access to the same data, but we should want the same result because we want the price to be right. But also the flip side of that is that there is some talk coming out of the Balkan that says that maybe some of the Balkan wells, their life expectancy isn't what they thought they would be. That some of the ratios are getting out of whack, and as Ham has a big play in the Balkan, so maybe his incentive is just to kind of keep his stock price up. He has been wrong in the past, like we all have, and so it's interesting. You get these CEOs out when they talk about the price. I'm always curious. They need their stock price to stay up, and if they're heavily invested in a certain commodity like oil, then it behooves them to project higher numbers. So it could be just as political, I guess, on both sides, don't you think?
It very well could be. Now, remember, Continental Resources is a public company, so yes, you could manipulate the data to increase shareholder value. The problem is it would eventually correct itself.
Right.
And Wall Street hates that. Wall Street hates when you miss a forecast, whether you miss it high or low. It's the fact that you couldn't forecast your own business. So I don't see him doing that. And I also know that Harold Hamm's not the one out there with a big Microsoft Excel spreadsheet trying to figure stuff out. He has a whole bunch of very smart analysts working for him that go out there, grab the data, crunch it, apply their expertise to it, and they report back up to him. This could be a case of where the analysts that are actually doing the work have access to data that maybe the EIA decided not to take. Because what happens, Ryan, is there's a lot of information out there, and when you're trying to do accurate forecasting, when you're doing predictive modeling around statistical analysis, some of that data you throw out, right? So you tend to throw out the data that is exceptionally high, and you tend to throw out the data that's exceptionally low, and try to concentrate with the data that's sort of in the middle, because the odds are it's a more accurate representation of what's going on. Not to get real deep into the science of this sort of stuff, but it's the discrepancy between EIA and what Continental Resources is talking about. It really tips my curiosity. I really can't wait to see, because we will find out why. It may not be this year, but by the middle of next year, that will true up. We'll figure out who was right and who was wrong.
Yeah, there's either going to be oil in the supply or there won't be. So it's one of those things that at some point you're right. We'll eventually be able to tell who was right, and then we can figure out what happened then. But with that being said, prices are trending upwards right now. It looks like OPEC's going to extend their cuts, but we're also seeing that companies, I think Ham's one of them, Cimarex is another, they're moving off of the credit line into cash, which means that how they've operated historically will change, just because they won't have the amount of resources just to go and drill as much as they would if they were on a credit line. With the prices trending towards 60, and I know you got your end of year predictions that'll be coming out here in a few months, but with the prices trending that way, if they continue and we see a $60 per barrel price as we go into 2018, do you think that companies are still going to move towards this cash basis, or will we say, you know what, let's go back to the kind of the way we've done it historically, where we have these large credit lines?
So this is a bit of a knee-jerk reaction by shareholders. This is oil was $130 a barrel. Money was falling from the sky. We extended credit like crazy. People went out and literally for extremely low or sometimes no margins, they went out and drilled because it was a race, right? Who can get the most wells in the ground? Who can get the most production? And then reality hit, right? When the market was oversupplied and prices plummeted. So this is shareholders saying, you know what? We don't want this to happen again. So if we move toward a cash-only type of environment where we don't borrow money or don't borrow much money, we can't have this huge negative financial rebound if prices crash again. This won't last. Our industry as a whole, and I mean all of it, upstream, midstream, and downstream, is changing. You're seeing things going on in midstream that's going to fundamentally change the way they fund their projects, their infrastructure projects. You're seeing technologies come into upstream that's going to radically lower the cost of actually going out and drilling and finding hydrocarbons. And you're seeing technologies come into downstream to help them become super efficient in refining that stuff and turning it to goods. So this is just, like I said, we see this as a knee-jerk reaction. We do, however, think that the glory days of, companies being having huge lines of credit that are, sometimes more than what the company itself was worth on paper, that's gone forever. It's sort of like the housing bubble, right? Once people figured out that companies were taking subprime mortgages and bundling them together and selling them off as a package, laws were put into place and business practices were changed so it wouldn't happen again. So that's what's going on with this. It's the nature of exploration and production in the U.S. is predominantly on smaller players. It's not the Exxons and the Chevrons of the world that produce most of the oil in the U.S. It's smaller independent operators. And the only way they can operate effectively is with a credit system. But I know, actually, I'm kind of plugged into that world with several of the big banks here in the Houston area. And they've cut dramatically what they loan to their clients just because they don't want to get burned again. So it's not good. We're not moving to 100% cash roll. That just physically won't work. You are seeing some constraints put in place by shareholders, and then like I said, you can see the business model change. You're seeing things like, Ryan, did you see the thing about Schlumberger becoming an operator, like doing some joint ventures?
I did see that.
I mean, that's a fundamental change in our industry. So Schlumberger now, and they're doing what they always do. So Schlumberger is very smart. Anytime they have an interest in changing their business, they always do a joint venture. Think about OneSubsea. Before they bought Cameron, Schlumberger formed a joint venture in the subsea services industry called OneSubsea. What they were doing is testing the market. They tested the market. They were able to make money. They go, okay, so they bought Cameron. This is what's going on right now. They're doing some joint ventures with some operators around the world. So now Schlumberger is a producer, right? But they're testing the water. the thing I think is genius about this is if they do this well, Ryan, they have several choices. They can make zero money from production. I want to say break even, but guess what? They'll source all Schlumberger equipment and people and processes and make the money on the service side. Or they can cut a really good deal with the services and the parts and pieces that the upstream operators need, which will lower their costs, which will make a marginal producer make more money than their competitors. So they've mitigated their margins in a way that I think is just genius. And like I said, they're testing the market, but our industry is changing. You're going to see service companies become operators. You're going to see operators figure out that they need to become more of a technology company. You're going to see midstream companies figure out that they're really a financial company. The industry as a whole is changing, and it's actually all good stuff. If we can manage to modernize not only our technologies in the oil and gas industry, but our business process, the way we make money, the way we use capital effectively, it's just good for everybody. So all it is jobs. That's more secure, longer term jobs for everybody.
Absolutely. And on the business model changing, you're seeing Wall Street right now push towards the CEOs of these producers and saying, hey, look, we don't want you guys to look at just going and drilling holes as a positive. We actually want to see you guys make good returns on the money that we're loaning you. And so just how the CEOs are thinking about how they're going to make money for their stockholders in the long term is going to be reflected. And we saw that with Pioneer back in the second quarter. They took like a $30 in 1 day drop in stock. And the analysts were seemed to saying, you know what, Pioneer, you drilled a bunch of wells, you missed some of your targets, and your gas to oil ratio was off. We want better returns for the shareholders, or we're going to punish you by devaluing your stock. And so I think that you're going to see, as you mentioned, a lot of changes, and it's going to start at the top with the CEOs who are feeling a lot of pressure from Wall Street right now.
Yeah, and one of the problems we had with the before the downturn hit is we had a lot of Wall Street money in this industry because there was money to be made everywhere. You could sometimes make 30 or 40% of whatever you invested. I mean, that's 30 or 40 cents on every dollar you invested. You get a return, a quick return. That's when it was in its heyday. And so what happened is the oil and gas industry knew that we're cyclic. We've been through it. This is my third or fourth downturn. It happens every 10 or 15 years. And so the people that really lost their shirt during the downturn was the Wall Street money. We need investment. We need capital. We need lines of credit, but we need to keep people that don't know our industry away from steering the ship. Right? They can provide the cash, they can write the checks, but they don't need to be lead. So, I think our industry as a whole, you're seeing a lot of stuff change. Both ExxonMobil and Chevron have new CEOs that come from downstream. That's never happened before.
Right.
The reason that's happening is because they both realize that downstream is now going to become extremely lucrative. Manufacture of paints and plastics and adhesives and petrochemicals, so they're all realizing that the part of their business that was not super profitable but was long-term forecastable has now become super profitable because the world has changed. The emerging economies need things like plastics and duct tape, right, which comes from oil and gas. The other thing that you're seeing that's I think is really interesting is, both Shell and Exxon have turned themselves into basically gas companies. Yes, they're still getting liquids out of the ground, but they both see, and I agree with them, that the future, and not now because LNG prices are low, but the future is gas, is LNG. We finally are at the point where we have the technology where we can move it around cost effectively. It's so much better for the environment. Just by switching to natural gas for electrical generation, you drop emissions 60 some odd %. So bunch of changes. Change is always opportunity. Don't, any of your listeners out there that are worried about what's going on, it's not bad. It's all good stuff. It's just going to be different. It's not going to be the same. It's going to be better, but things are just going to change.
Well, Mark, we'll get you out of here with this. We had on Paige Wilson the other day, which I dubbed the Rookie of the Year in Energy Podcast. Her show is just going berserk right now. But I want you to go ahead and plug and promote. I know you guys are doing a lot of great work over there. Let the listeners know where they can find you, your shows, the other shows, the website. Get it all out there, where they maybe can meet you if you have some upcoming events that you're going to be at. Just go ahead and plug it all, man.
Yeah, so all of the current podcasts and all the future podcasts are part of the Oil and Gas Global Network. And you can go to oilandgasglobalnetwork.com and see what we have going on. We have 3 podcasts right now. So Oil and Gas This Week, Oil and Gas HS&E, Oil and Gas Industry Leaders. And we have 10 more in the works. You and I talk about that off the mic. It's crazy. It's all good stuff. One of the things that we're doing for our listeners, and we'll offer it to your listeners as well, is that if you have a company, small or big, and you want exposure to our audience, we'll let you do it for free. We're letting our listeners post. We prefer short videos, but if you have videos text, audio, whatever, we will happily for free post it on Oil and Gas Global Network so you can get exposure to our audience. Now, you can't be too salesy, and what you post has to be useful and valuable. But if that's of interest to you, reach out. Ryan will put my contact information in the show notes. But it's just been a great ride. And, Ryan, you and I talked a little bit about what's going on with this show and your future shows, and we have a lot of growth. What I find interesting is the number of what I call new media. So the people that are doing blogs, podcasts, vlogs, that sort of stuff, using social media. Every show you and I go to, Ryan, there's another person. There's a newbie that's just starting. And I think it's really cool. I think, everybody says I'm crazy. And I've talked about this on your past shows about how I think in the future, oil and gas industry is going to look like Silicon Valley, be fast and sexy. Part of that is changing the mindset of the public, because most people outside of any oil producing region, most people in the world think the oil and gas industry is environmentally unresponsible, is dirty, is not safe. And we all know that's not true. Well, guess what, Ryan? You with this show and us with our shows and all our fellow new media people that are out there are telling the real stories of our industry. We're helping implementing that change. One person at a time that listens to your show hears something to go, oh, I didn't know that about oil and gas. And that's a beautiful thing. We are going to literally change the perception of the world about our industry. And our industry is the greatest industry on the planet. We bring prosperity everywhere we go. So I'm just excited to be a part of this. I'm excited you're playing a part of this. If any of your audience out there, has an interest in starting a podcast or a blog or something, and they need a little help, I'm busy, but reach out to me. If I can help you, I'll be glad to help you, because you're not competition. This is like family. We're all doing this together, and it's just a wonderful thing.
Yeah, and I've said before, I think you've got the moniker as the nicest guy in the business, and that's true. So if the listeners are interested, Mark is kind of a mentor for me in this process and has been very helpful. But, you touched on one thing I think is really important, is that on this show, we've had people who are, right, left, center, all over the spectrum. But, one thing that's very clear, Mark, is that when you talk to people in the energy business, oil and gas, solar, whatever, we all care about getting energy to people, and when you kind of lead with that, you say, you know what, I want to get energy to people. It's just like you brought up just a minute ago. You know what, if I'm in oil and gas, but if we switch to gas, you see these kind of effects that help the environment. Okay, well, most people look at oil and gas folks and go, they don't care about the environment. Well, that's just not true. And so these type of formats, in my opinion, the biggest thing they do is they take us off of Fox or MSNBC or wherever, and they allow us to actually just talk as two humans, and you'll get our ideas out there and learn from each other and show that we actually share a lot more in common than portrayed in the mainstream media. So I've enjoyed this. I've enjoyed your show, and we will definitely point the listeners to all of your stuff. You're doing great work over there, Paige as well. And thanks, Mark, for coming on and being a part of the show. We really appreciate it.
Yeah, Ryan, all the best. I appreciate you letting me come on again, and I'm sure we have more stuff like this in the future.
Thanks for listening to the Global Energy Leaders Podcast, powered by R Squared Global.